Hi, Tiffany. Welcome to the Gain Meets podcast. Welcome everyone to this podcast on responsible investing in fixed income. We're thrilled to have you with us today from New York. So a nice transatlantic conversation. And we'd love to start out by just hearing a bit more about you personally, your background, how you came into this work, and what you actually do day to day.
Well, thanks, Natasha. Thank you for having me on the podcast. So I'm Tiffanie Wong. I work at AllianceBernstein. I'm the director of fixed income responsible investing portfolio management, and I also lead our U.S. investment grade credit portfolios. So I'm a portfolio manager. I manage bond portfolios. I've been doing this for 17 years now. And so it's been a while. I started my career in 2007 after I graduated from college, and I happened to fall into fixed income. It was by chance. I knew that I wanted to work in finance, but I didn't really know what within finance I was interested in or I was good at. And so I did all the interviews junior and senior year for internships and kind of ended up in, at sell side shops for internships. And senior year, I got a position at an asset management firm out in San Francisco, which I decided to take. But once I had received the offer, we had to re-interview again to see what team we would be placed in. And I happened to get started in the U.S. investment grade credit team. And so just happened upon it by chance. Um, and so when I think about my career progression, um, a lot of my clients when I was managing investment grade credit portfolios or when I was on that team were insurance companies and pension funds. And if you think about insurance companies, pension funds, I think they were probably at the forefront of, what we think about ESG or responsible investing. We often had instructions from them to not invest in companies that produce tobacco or produce alcohol. And that really was like, I think the first foray into ESG or responsible investing. It was like excluding certain sectors from portfolios. And so I think in that vein, right, it was very natural for me to get up to speed on how our clients viewed responsible investing and evolve with them as they kind of change their thinking about what they wanted responsible investing to mean to them. And so that's how I got into my second, into responsible investing in addition to investment grade credit investing.
Oh, that's super interesting. Maybe you can describe a little bit actually what it means to be investing in the US investment grade credit. What is that universe like and what are the characteristics?
Yeah, so I think more people are probably familiar with the stock market with equities, where you buy a share and you end up being an owner of the company. As a fixed income investor, we are investing in bonds. So that means we're lending to companies or governments, right? We're deciding to assess whether or not a company is worth lending to. In return, we get interest payments from them in the form of coupons. And then at the end of the life of a bond or upon its maturity, we expect to receive our principal back, so the amount that we lent to them. Um, and so as a fixed income investor, as a US investment grade bond investor, I am looking at companies, looking to lend to companies that issue bonds into the US dollar market. And so as a bond investor, I care about a couple of things. I care about the credit worthiness of who I'm lending to. So are they willing to, and do they have the ability to pay me my money back? And so I think that's very different um, from the mindset of an equity investor. An equity investor is very optimistic. They think about the growth prospects of a company. A stock price can double or triple in price. So there's in theory, unlimited upside, right? If you're an equity investor. As a fixed income investor, I care about risk management. I care about what can go wrong such that a company will fail to pay me back what I lent to them.
Right. And the
So I
credit
think it's
rating,
different
essentially,
mentality.
yes, and the credit rating of a company helps you assess the riskiness of that. So when you say investment grade, you're looking at high quality companies that have strong balance sheets and they're
Yes.
rated by external agencies on their credit worthiness. So that's why investment grade is the AAA kind of company.
Triple A all the way to triple B.
Right.
So there are three large rating agencies that assess corporate bonds or government bonds, right? The fixed income market. You have Moody's, S&P, and Fitch. And so when I say investment grade, it means triple A. That means, these are the really stellar companies, very, relatively lower risk or lowest risk, all the way down to triple B. And triple A down to triple B is considered investment grade. So highest quality companies, large cap companies, they generate a lot of cash flows. You have higher degree of confidence that they will pay you back. Then you go down to below triple B, and those are the high yield companies, the more speculative companies, typically private, smaller, maybe don't generate as much in cash flows. And those are double B all the way to triple C rated.
Right. So they'll pay you a higher interest rate to borrow money from you as a bond investor, but you have a higher risk of maybe not getting your principal back at the end of the term of the bond,
Absolutely.
of the bond. And so an example of an investment grade credit in the US would be like Apple, right?
Yes, exactly.
And if you look at then the responsible investing part of it, that sounds much more tricky because a bond is only for a certain period of time. So you're buying a bond from Apple, let's say, for 3 to 5 years. And so then you're looking at their responsible investing policies and what they're doing over that time period. So how do you get comfortable with that, and how do you actually analyze that profile?
Yeah, so in terms of responsible investing, I think let's kind of step back. It can mean a lot of different things to different people and different companies. Um, so at AllianceBernstein, we think about responsible or responsibility through three lenses. The first one is more corporate responsibility, like what are we doing as a firm? Things like our own carbon footprint or energy efficiency, diversity, equity, inclusion policies, etc. But the second one is as we're managing client portfolios and analyzing credits, we want to integrate financially material ESG considerations into our investment process. So that's idea generation, that's research, right? Research into the companies, that's engagement with the companies. That is our investment decision making process. And so, what we think are if there is a material ESG related risk, that's actually a credit risk, and that might impact the way we assess a company's credit worthiness or ability to pay us back our principal. And likewise, material ESG opportunities can actually also be credit opportunities. And so even though we might be investing in an Apple 5-year bond, and I might not care about, I just care about getting my principal back at the end of the 5 years, in reality, we're underwriting credit to maturity, meaning we're analyzing companies as standalone companies, regardless of whether or not we're investing in a 2-year bond or a 5-year bond or a 30-year bond. We want to look at the company's fundamentals, their credit metrics. There are certainly some ESG risks that are more imminent, that might materialize quicker, but then we also understand there are a lot of ESG aspects to ESG that might take place over a really long period of time. And so we have to take into account all of these different risks and opportunities.
And of course, you have to do all that hard work yourselves because Moody's and Fitch and S&P doesn't offer you the credit ratings on ESG the way it does on the credit risk.
Yes, absolutely. And so I think that's one of the struggles. You have had a lot of companies come in and assess ESG risks and opportunities. So companies like MSCI and Sustainalytics, even Bloomberg have come in and done a lot of ESG research themselves. And so I think they are good resources, but ultimately we think that we have credit analysts who are experts at looking at the companies that they cover And so therefore, they are the best position to also assess the ESG related risks and opportunities. And so we like to use our in-house internal research, and which might be quite differentiated from MSCI or Sustainalytics or Bloomberg. What we've found is that a lot of these third-party data providers have very much an equity lens, an equity focus. And so there are things that they don't take into account, um, coming what we would care about as a fixed income investor. Things like governance, for example, um, or even things like environmental issues where um, companies might actually issue ESG labeled bonds that are very unique to the fixed income market. So those are all things where, we can leverage outside research, we can leverage Moody's, S&P, and Fitch for credit ratings, but ultimately we want to have our internal ratings. We can leverage these ESG data providers for data points, but we ultimately want to go back to our credit analysts and rely on their internal research for
Right.
ESG.
So you access all this external information and sort of data points
Yes.
to then do the analytics internally. Tell us more about your team and sort of how it is organized and what is the life of a responsible investing credit analyst?
So our credit analysts do both the traditional credit research as well as the ESG research. So our analyst team, we have analysts across New York, Nashville, London, Hong Kong. So we have a global analyst team. I think that's very beneficial for us because we're able to compare um, credit metrics across region, across credit quality, investment grade or high yields. And so we do expect our analysts, and they're often quite busy listening to earnings and going to industry conferences and trying to understand not only the companies that they cover, but really any sector trends that might be impactful. Understanding the macroeconomic environment, because quite often, right, um, growth or inflation might impact how their companies perform. And so I think they build a lot of models, right? They talk to a lot of other analysts. They talk to our equity analyst counterparts, and they work a lot with data. Right? That's what a credit analyst does. They try to use that data to help inform what their view is of that company, not relying on a S&P, Moody's, or a Fitch.
Right.
So we, as a portfolio manager, I take their research and I try to utilize it in portfolios. If my analyst has a certain view on a credit, how should I be using that to position our portfolios? Should I be buying a security? Should I be selling? Should I be trimming? Should I be, are there certain risks in my portfolio that I should be aware of? So as a PM, I have to take credit research. We also leverage quantitative research at AllianceBernstein within fixed income. And so we take the research outputs from our quantitative team. And then the third prong is trading. There's only so much you can do based on research. In theory, you can say, I have built the perfect paper portfolio. But if you cannot actually buy the bonds in the market, then you're back to square one. So we actually work very closely with our trading team as well to try to understand what the liquidity is of these bonds. So how easy or difficult is it to source these bonds or sell these bonds, and make sure that we're taking into account all these different types of information as we're building a portfolio.
And that's very different from the equity world because there are stock markets where shares are pretty much liquid unless otherwise noted. And the
Yes.
corporate bond market is not like a stock market. So you have to figure out where your supply of bonds will come from and where you'll also have customers for bonds that you want to sell. So that adds another lens, essentially like a filter to your process that also adds risk potentially. So you look at that in addition to everything else you said.
Absolutely. The equity market is, you can search for where a stock is trading at any given time. You don't have that kind of transparency in the fixed income market. You have to talk to a lot of different dealers. Different dealers might be quoting the same exact bond at completely different prices. And so it's up to our traders and our teams to figure out what is actually the right price and to go execute at the best price.
Mm. And how have your clients evolved along the spectrum of, first just excluding certain issuers to maybe then screening and engaging? What do you see as the predominant mix of client demand for these sort of filters?
Yeah, so I talked a little bit about how AllianceBernstein views responsibility. So the first one, corporate responsibility. The second one is ESG integration. But really, the third approach is building out solutions for and in partnership with our clients. And so, to your point, I think years ago when I first started my career, it was all about exclusions because that was the easiest thing to implement in portfolios. Don't buy tobacco bonds, don't buy alcohol bonds, don't buy, thermal coal bonds, for example. That has evolved as I think clients have become more sophisticated and more educated on the full spectrum of potential ESG related risks and opportunities. So things like climate change and biodiversity. And let's try to be a little bit smarter about how we incorporate our sustainability objectives, because there is a view, right? If you simply exclude companies, sure, you're not including it in your portfolios, but are you actively helping those companies become more sustainable? And by not buying their bonds, you're not really doing that, right? And so engagement is another way you can actively try to influence a company to, one, disclose more information, right? For example, or two, encourage them to continue doing what's good for the company, and then also what's financially, right, additive, or to stop doing certain things that you think are going to be detrimental to their credit metrics. Um, and so I think, where we've kind of evolved to is there's no one size fits all approach. Every client wants something different. And so it's really important for us to be flexible, not impose our own views of what a portfolio should look like, but really try to understand what is the company trying to accomplish. So we've had clients come to us saying, we have a bond portfolio and we want to decarbonize that bond portfolio. So the portfolio's bonds or the underlying companies have a certain carbon footprint. How do we shift the portfolio so that we're investing in companies with a lower carbon footprint? And so those are the types of nuances now that they're a little bit more complicated than simply excluding certain companies. We've also built out strategies that are thematic in nature. So what we call our portfolios with purpose. Within fixed income, we manage sustainable strategies. And so strategies that are aligned to the United Nations Sustainable Development Goals. We're trying to invest in issuers that promote, right, environmental or social good. And so those are also of interest to certain clients. So really, it depends. There's a spectrum. There's really no right or wrong answer, but we've definitely seen a wider variety of different types of strategies.
Right. So you have your core internal ESG process, ESG integration process, and then layered upon that are the client requirements that are either objective driven, like net zero in the portfolio, or thematic in terms of reflecting the priorities of the UN SDGs and how you organize that. And then that requires, I guess, not just more of the quantitative modeling of portfolios and figuring out the structure of solutions, but also more engagement. So how do you do that on the bond side? Equity investors, they get to vote at the annual general shareholders meeting. They get visits with the CEO and the CFO when they go on the roadshow. How do you engage with companies?
Yeah, so we engage in the same way. So the benefit of AllianceBernstein is we have an equity team as well. So oftentimes we engage collaboratively our equity analysts and our fixed income credit analysts will go meet the company at the same time. And that actually has benefits because then you make sure that the company isn't saying one thing to equity holders that's beneficial to their stock price and saying a different thing to bondholders. So we've had examples of very successful engagements where we put kind of both of our analysts in the same room with company management, and they are able to have a very productive conversation on projects that they are planning on starting, right? Or what they're spending their money on that will kind of evolve their electric vehicle sales, for example. But and to your point, right? It's equity holders. You have a seat at the table because you own the company. Fixed income investors, we're just lending to the company. I would say for certain fixed income bond markets, like high yield companies or emerging market companies that tend to be, they might be private companies. They don't have equity. They don't have publicly traded equity, or they're smaller companies that are reliant on the fixed income market for access to capital. That means they need to borrow money all the time. They can't just issue shares. In those cases, fixed income investors do have more influence when engaging with these companies. And we've found that, engaging with high yields or emerging market corporates has been quite successful as well.
That makes a lot of sense. And so who does that at AllianceBernstein? Or is it within your team or a separate team to represent the fixed income perspective?
So our credit analysts will lead the engagements, but then our portfolio managers, our traders will attend as well, because I think it's really important for us to also engage in these conversations with companies and understand how they're tackling or addressing some of the questions that we're asking them. We also have a firm-wide responsibility team that is focused on higher level research topics. And so we have a team focused on E, environment, a team focused on S, social, and a team focused on G, governance. And quite oftentimes they will also attend some of these engagements as well, because they provide kind of that higher level expertise. They're not as focused on an equity or as an equity investor or as a fixed income investor, but they can really ask the higher level and corporate level questions to companies.
That's great. It's always useful to have the generalists and the specialists in the room together. Maybe you can
Absolutely.
share with us an experience from a recent meeting like this and how it influenced the investment process.
Yeah. So what's interesting is as a fixed income investor, sometimes our engagements are focused on ESG labeled bonds. And ESG labeled bonds are a part of the fixed income market where, if I think about bonds in general, right, you're lending money to a company, and a company can take those proceeds and they can spend it for general corporate purposes, or they can use it to engage in an M&A transaction to buy another company. But a company can also issue an ESG labeled bond where the use of proceeds are supposed to go towards a project that funds a green initiative or a social initiative or a combination of the two. So think things like renewable projects or social initiatives that are designed to increase lending to underserved communities. So we're lending them this money and they're supposed to be using it towards green and social projects. And so these bonds are actually quite interesting, and it's a very fast growing part of the fixed income market. I think in Europe, in the investment grade European new issue market, so newly issued bonds, up to a quarter of all that issuance is ESG labeled. So this is certainly something that companies are very aware of, that there's investor demand for, and so it's gotten very popular. So one of the engagements, more memorable engagements that we did over the past couple of years, was we engaged with the World Bank on one of the first wildlife conservation sustainable bonds. And so it was a really interesting structure because the coupon payments were designed to go towards two South African wildlife, black rhino conservation areas to try to increase the growth rate of the black rhino population. And it was such a fascinating bond because this is not something that we typically work with. We're not black rhino experts, so we had to talk to the World Bank. We spoke to NGOs to understand, right, what were the historical black rhino population rates, what are some of the risks going forward, like poaching and disease. But the structure of the bond was very interesting because instead of the investors receiving the coupon payments went to conservation efforts. And every year, we would get the annual population rate of the black rhino population. And if it met a certain thresholds at the end of the maturity, we as bondholders get a success payment. So it was
Wow.
a very interesting structure.
Very
It required a lot of engagement and, education on our part, and required some, back and forth on what the success payment should be, right? Because ultimately as bondholders, we want to make sure that it makes financial sense for our clients, but then, the added sustainability objective. So that was one that was really memorable, and I think a really interesting structure that we ended up putting in portfolios.
No, it sounds incredibly interesting. And, rhino fertility rates is definitely not an area that all of us are familiar with. So this is
No,
truly impact investing in the wild.
yes, and like we learned that why black rhinos, because they're endangered and they're usually a good signal for biodiversity in the area. So it was did I imagine 17 years ago that I would be working on black rhino bonds? No. But this is how kind of the space has evolved over time.
Fantastic. And it demonstrates also why fixed income is so interesting in that it's so innovative in terms of the structuring of products, which makes it very different from equity. Equity is pretty straightforward unless you get into derivatives, which are sort of a very different field altogether. Whereas fixed income, by its very nature, lends itself to be highly differentiated asset class with a lot of variation of the tools you can use and how you use them. And a lot of it is really bilateral based on who's the lender and who's the borrower. And you mentioned with the demand for ESG bonds, is there also a difference in terms of how they're priced? Is it more attractive to companies to do it this way, and that's why the demand is coming, or it's because the investors tend to hold it to maturity and it's just a different kind of set of investors out there as well?
I would say a little bit of both. So first off, I think some of these bonds tend to trade, or I guess are issued at a lower coupon rate relative to a non-ESG labeled bond. So it's actually beneficial for the company because they're paying lower interest rate. And that's because of the supply and demand dynamic, as you've highlighted. There are more investors that want these types of bonds in their portfolios because they can tie those proceeds back to a specific project and they can say, I invested in a black rhino bond, and I know that those payments are being used for black rhino conservation efforts. Likewise, you can invest in a green bond of a utility company, and okay, those proceeds are being used to build a renewable energy plant. And so there's certainly more demand. And I think, really the market started probably 9-10 years ago with the first green bond. So the green bond market is the most developed, most mature. It's the largest market. And you did see more investors kind of buy these bonds and tuck them away. Because there's been more issuance of these types of bonds, there's more of a tradable market. And again, the green bond market is quite large. It's the most mature. And so people tend to trade around that. I would say there's probably, in the US market, there's been less of this type of issuance for a whole host of reasons. And so there's more scarcity value in the US. And so they tend to trade even tighter. Or, we place more of an emphasis on kind of trying to source these bonds in the US market. So I do think that they're becoming more mainstream. And so therefore you might see kind of the pricing differential collapse a bit. But for the moment, I think, to your point, they're very interesting structures. There are lots of different types of projects. And in some ways, it makes it more difficult or challenging for us to analyze these bonds across the board because they're not apples to apples. They can be funding different types of projects. Not to mention, there's a completely different structure called a sustainability linked bond, where the coupon of those bonds can actually step up or step down based on the company's ability to meet certain sustainable targets or key performance indicators that they
Right.
set
So
out
their
to
cost
achieve.
of borrowing can go up if they're
Yes,
not doing well, or it can go down if they make a lot of progress during the time that they have borrowed this money.
exactly.
That's very interesting. I'm a non-executive director in an emerging market company that the EBRD had invested in as well, and they are basically helping us to do the first green bonds because they're really good enablers. And one thing they've pointed out is that it opens up a whole new opportunity set of investors because not the same investors will go and try to buy an emerging market stock in a frontier market, but these ESG bonds and especially the impact linked bonds have a broader, very different audience. So responsible investing in fixed income has actually brought a lot of opportunity to different kinds of companies to access capital markets.
Yes, absolutely. And for our sustainable strategies, we actually have a minimum allocation to ESG labeled bonds because we think that they, add an additional layer of kind of achieving that sustainability
Right. So you have
in our
like an
portfolios.
intentional almost
Yes.
view of how to get more of those in the portfolios. That's great to know. And so, what makes you excited about the prospects going forward, and what kinds of things are you keeping track of in terms of developing news, developing trends?
Yeah, so I mean, what's so great about responsible investing in general is that it's so fast moving. Everything is changing at a very fast clip. There's new research that comes out, there are new developments. And so I feel like in some ways I'm constantly learning. I'm not an expert at anything because there's so much more to learn. And so I think, what we try to do is try to stay on top of like the latest developments, read news, read research reports from the sell side or NGOs or other external organizations to stay on top of what is developing. And certainly one of those aspects is regulation. There's so much in the way of ESG related or climate related regulation that impacts the way a company might report on certain metrics or a company's behavior that we as investors need to be completely switched on to because it might impact, again, going back to the credit worthiness and the financial materiality of risks and opportunities. Um, but I think it's, also talking to our clients, understanding what they want. And that's how we're able to partner with them and best develop a solution for what they're trying to solve for. And so I think there's the most exciting aspect is I'm constantly learning.
That's excellent. What do you like to read? Any advice for the students in our audience of what they should be reading to be up to speed on these developments and just fixed income in general?
I would say the financial newspapers, great resource because I think, especially in the world of RI and ESG, it's every single day there is some article, right, on ESG, on
Mm,
responsible investing.
it's true. Even the
Um,
Wall Street Journal, I've noticed.
yes, yes, absolutely, and even just generic, even non-financial
Yeah.
articles like New York Times. So there, I think just reading as much, from newspapers, media, and then I think there are organizations that kind of where you can learn a lot from. So even just United Nations Sustainable Development Goals, right? Just learning about that. There are a lot of more fixed income focused organizations, like the Climate Bonds Initiative. They're like the Emerging Market Investors Alliance,
Mhm.
where you can go on their websites, you can learn things. So at AB, we partner with the Columbia Climate School to do a lot of research. So even there are lots of, academic organizations
Mhm.
that are starting to create certain programs um, for ESG investing. The CFA has an ESG certificate now. So
Yeah,
I think there are lots of different resources, but really just trying to read as much as you can and speak to people and get their experiences on how ESG has impacted the way that they invest. I think is always a very interesting perspective.
that's great. Thank you. Do you have a favorite podcast or a newsletter?
Ooh, that's tough. I would say I'm not a big podcast person. I like to read, um, but I do like reading sell side pieces.
Okay.
And then there is an organization called the Anthropocene Institute that also publishes a lot of more bond specific ESG related news, especially on ESG labeled bonds and structures.
Anthropocene. Great.
At Anthropocene Institute, yes.
We will include that in the show notes.
Thank
Thank you so much, Tiffany. Thank you for taking the time to speak with us, especially since you're not really a podcast person. This will be really useful for our students, and good luck with everything. Most importantly, good luck with the maternity leave and the growing family. Congratulations.
you very much.
And hopefully, we'll speak to you again soon.
Okay, thank you so much, Natasha. Thank you for having me.
Thank you. Bye.